Hey guys, welcome back to the channel McNallie Money, the new home of power mining analysis. In today's episode, Anthony Power and I are going to be joined by the full team from HODL Corp. We're going to be discussing earnings, which just came out yesterday, with the new CEO, Asher Genoot, along with a couple of members of his team. Now, this is super exciting for HODL, you guys. They were up in excess of 20% during yesterday's session. They closed up 10% on the day. A very strong showing for HODL Corp, and a lot to go through in today's presentation. Now, before we get into it, please take a second, hit the like button, you guys. It's a huge help to myself and the channel. Anthony's a big fan, and it helps push this content to other people who may find value. If you're not already subscribed, McNallie Money, feel free to join. We're almost at 43,000 subscribers. We'd love to have you as part of the community. And finally, you guys, leave a comment in the section below. Are you currently holding HODL Corp? What did you think of earnings? And what's your outlook for 2024? Now, with that being said, let's get into today's video. Okay guys, so that's right. Today's video, we've got the CEO, Asher Genoot of HODL Corp. We've also got our good friend, Sue Ennis, who's the head of IR, here to talk everything earnings. Now, HODL came out with earnings obviously yesterday. The share price rallied in excess of 20%. It closed out in excess of 10, so a massive move for you guys today. First off, Asher and Sue, congrats on a great release and some great price action yesterday. Thanks so much for being here.
Thanks for having us. Really appreciate it.
Yeah, it's an exciting time in the world of HODL. I know we've been with you guys for a long time, and things are finally seeming to be on the right track. Asher, you've came to the helm here. We've talked about kind of your new strategy, your new plan coming to fruition in Q2, but I wanted to just get a pulse check. Since you've taken over for Jamie, what's been the vibe, the energy, the feeling at HODL Corp?
It's been great. I mean, it's electric. Sue can give you some kind of context there as well, but I think there's a lot of work to do, and everyone knows the work that we have to do, and everyone's hungry. They're excited. We have a lot of folks that know what we're capable of, and obviously the stock hasn't reflected kind of what we believe the value is, and so people are very, very excited to build, to restructure parts of the business, to focus on growth, and so it's been electric energy. We're in the office till very late every day. We're here on weekends. Sue flies down from Toronto every other week, so it's been great energy, and I would love Sue to chime in a little bit as well as kind of the pre-post on the HUD side as well.
Yeah, I mean, one of the things I've been telling quite a few people is that I obviously wasn't there, but this kind of has that feel of Facebook in 2007, like right when it was starting to, things were coming together, the culture, the energy, that's what it feels like. And I do genuinely believe that this team can do absolutely anything. And everyone is just really excited to come to work. And like, I was even saying last night, we had a little team dinner. I was saying it almost feels like we're part of something bigger than us. Like it's obviously, we're incredibly focused on Bitcoin mining, bullish on Bitcoin mining, but this is also an energy story. And so, yeah, we're really excited and jazzed. And earnings yesterday was great. And we're just getting started. So
I think culturally too, we're a public company. We have a public market cap, but we're not content with being around $1 billion public company. We see ourselves very much as a high growth kind of startup where we have to figure out how we can 10x the business and continue to grow. And I think that balance there as well is like being thoughtful because we want growth and longevity in our growth. And so that's why one of the easiest things for me to have done is come out of the gate and say, we're going to buy all these machines and then we can grow in the short term. But it's how do we deploy the capital that we have very, very thoughtfully to be able to create long-term sustainable growth and continue to compound this business.
So we've obviously just seen the announcement yesterday for the earnings, but can you just sort of like give an indication to viewers some of those highlights? And also just to explain some of the nuances with how those accounts have been put together, bear in mind the merger only occurred at the end of November.
Yeah, so US Bitcoin Corp was the accounting acquirer for HODL Mining Corp. And I think that's a key distinction that people didn't realize. And so we formed a new company called HODL Corp without the mining. And HODL Corp is a Delaware US-based company. And HODL Corp now has US Bitcoin Corp and HODL Mining Corp as the subsidiaries. And so when we look at the financials, all the financials before December, which is when we merged, are all US Bitcoin Corp. Then in December, so starting in December, HODL Corp was formed. right? And then Hut 8 Corp included US Bitcoin Corp and Hut 8 Mining Corp. And so December is a combined financials. And so I think this is important because first, there's a lot of kind of things out there about US Bitcoin, how healthy we were historically, what our business looked like. And so all the financials pre-December was just US Bitcoin Corp. And I think why that's important is we raised around $110 million. I think we built a pretty sizable business that's competitive when a lot of people have to spend hundreds of millions, if not billions of dollars to gain that amount of scale. And so I think that's kind of part one. And so when we look at the financials, there's a couple kind of key highlights in my mind. Number one, and also the way that the financials are built, it's a stub year because our year end at US Bitcoin Corp was June 30th. And primarily because we were a smaller company, we said, hey, we want more auditor time, so let's not do it on December 31st. So Hut 8 Mining Corp was December 31st. So as a part of the new company, we said, all right, we're going to change our fiscal year. And so in the financials, you have a 6-month period from July to December because we already had the June audited financials already. And so that kind of gives some context and background to the numbers. So we don't have the Bitcoin mined from Hut 8 through basically January through to November. We don't have the costs. And so like all of that isn't in there, right? And so that's why December, and we also in our MD&A section, not only showed you kind of like the year numbers, but we actually broke out the quarterly numbers as well to add even more transparency. I think the biggest thing going into this earnings and the conversation that I've had and listening to the market and answering shareholder emails is people want transparency. Whether you're good, you're bad, they want to know the truth so they can make a good investment decision. And so that was really an area that we focused on was how do we drive more transparency into our company and how can we stand behind these metrics? And if they're great, then amazing. And if they're good, then let's make them great, right? And I think it's having the confidence to know if we want to compete and we want to be one of the best and largest scale miners in the sector, we need to be comfortable showing the metrics and just proving them month over month, quarter over quarter, and executing on them. And so a couple kind of, I think, key metrics that are important. Number one, our cost to mine a Bitcoin. So our cost to mine a Bitcoin, excluding hosted facilities, was $16,000, $353. Our cost to mine it, including hosted facilities, was $18,815. I think that's important, right? Because I think some of the numbers out there are like 3, 4, 5 times that. And one metric that I think will become more common as well, we were thinking about including it and didn't because I don't think there's a normalization in the market today, is your all-in cost of mining Bitcoin. What about corporate SG&A? I think right now a lot of companies have very high corporate SG&As. What I love about our business is we have these fixed revenue streams from colocation and hosting and from our managed services business and from our data centers where that offsets a lot of our fixed costs. And so for me, when I look at our kind of cost of mining Bitcoin when it comes to kind of energy versus our all-in costs, including SG&A and such, like those numbers are pretty close rather than massively different for kind of some of the players in our space that don't have anything else offsetting those costs. And so I think as the market continues to mature, I'm excited for continued transparency, continued normalization in metrics, so then people can really compare companies apples to apples. And one element as well is depreciation. Depreciation is when you buy something, how long you depreciate that. So having unified depreciation schedules, some miners are 2 years, some put them across 4 years, but also infrastructure. Some people put infrastructure across 5 years. Others say, oh, it's data centers, let's do it across 30 years. So I think some normalization there is important. And why that really matters is, like, if I went and raised $5 billion, I would have a much bigger company today. But we had raised 110 million and then we combined with Hut 8. And I think that's important to note because how big you are should be relative to how much money you spent and your cost of that capital. And I think that's critical, right? And that's why when you think about the all-in number, depreciation matters in a normalized metric because it shows people like how much did I spend to get there? Because right now it's kind of this mindset of grow at all costs, which we've had a very different approach to and a very different mentality towards.
Yeah, that's certainly the challenge when we're moving forward and doing comparison with miners with all these metrics that you highlighted there and the differences in what people use to calculate those, and that's the challenge. That's why normally I look at the cash costs, but there is a role to be played to incorporate what the cost of acquiring infrastructure, acquiring miners. So that cost needs to be sort of built in, and we need to do it fairly across the board. And so I'm happy to work with you and the rest of the mining community to sort of like look at how we can do that and be, more standardized. And that's one of the aims, that we're trying to achieve this year. Now, it was great to see, the profit coming through for that 6-month update there. Looking through the balance sheet, which I assume is the full balance sheet for the fully merged company as at the 31st of December, there was a sort of like just an area of, that people have a concern about is regards to the sort of like the debt levels. Can you sort of like, explain about the current debt on the balance sheet and, are there any plans to reduce this, or is there a plan in place as to why that debt's on there?
Yeah, I'll chat through it now. So in total, the overall amount of debt that we had at year-end financials is $187 million. And the number sounds big, right? It's a large number. It's like, oh, you have this debt. And I think a lot of the fear comes from back in 2022, all the companies that had debt basically went bankrupt, right? And so in those bankruptcies, I would probably argue that we grew the most during that period of time as a company, whether that be through the Computer bankruptcy, the Celsius bankruptcy, and so forth. And so I think we really got to understand why people went bankrupt and what went wrong. I think that's really important because you can learn from those mistakes and you can basically structure things better. And so when I look back at 2022, there were a couple of reasons that kind of caused the collapse of a lot of miners. One was, one example, at Computer, I think on the site level, they actually had great economics. The problem was they brought on too much capital and grew too quickly, and that capital was in debt. And then basically markets turned and they weren't able to actually get sites online quickly enough, and they had to service that debt, and they weren't able to service it, and they kind of brought everything down, right? And then you have other examples like Corp, where you basically had a mismatch in terms of debt servicing, energy rates going up, fixed contracts on the other side on hosting, and you basically had that mismatch, and you had that liability on one side, and then you had the liability that you had to deliver something, but then you had costs go up disproportionately because it wasn't really a fixed energy rate, right? And so I think, and then obviously on kind of the FTX and Celsius, I think that was more so a mismanagement of funds and kind of where funds were going. But a lot of that also, I think, opened up the world of how much money was spent in order to achieve growth, and was that money spent, was it actually sustainable, right? Because, all right, you borrowed the money to go build it, could you actually pay it back? And that's why I think the cost of growth is so important. And so through all of that, I think we learned a ton. We learned a ton about what went well, what didn't go well. So when we look at our debt, I think it's really interesting to focus on how it's broken out. And I'm going to explain to you each tranche of that debt. And that because in my mind, in the future, we continue to want to finance on the project level, both equity and debt. And I think by breaking down the 3 tranches of debt we'll have, then I'll explain why, because the number might look big, but we don't believe that the liabilities and we don't believe that the maturities and the way that they're getting paid back creates a big strain on the business, which is why we think it's healthy debt and we think the cost of capital is relatively cheap. And so first tranche of debt we have in on the December 31st is basically the Coinbase loan, which is a $50 billion loan, right? And that's been expanded a bit post December 31st. That's been announced publicly. And so that $50 million loan was encumbered against 2,382, isn't encumbered against 2,382 Bitcoin. It was encumbered against more. We were able to reduce encumbrance because of the Bitcoin prices going up. But I mean, when you really think about it, 50 million, right now it's at 65, so we added that $15 million additional. But 65 on our Bitcoin stack of over 9,000 Bitcoin, that's trading right now based, I don't know what Bitcoin price is right now, but call it $600 to $650 million. It's a relatively low LTV. And so we feel confident there. The interest is around 10.5%, but that is also based on kind of the kind of federal rates. And so if the federal rates come down, that interest rate will come down as well. And so why that's important is I think taking a Bitcoin-backed loan is a pretty liquid market. So even though we have an expiration coming up this year, if we wanted to pull more capital off Bitcoin, just refinance that, that's a relatively easy financing structure that's available in the markets today. And so on the Coinbase loan, we're comfortable with it relative to the interest rates based on where interest rates are today and kind of cost of capital, and then also relative to the LTV on the overall kind of Bitcoin stack that we have. The second piece of debt that we have is the Anchorage debt. And so the Anchorage debt is a little over $40 million. And the way that that deal was structured and restructured actually was 5-year term. And we're about a year in, so 4 years left. And the servicing on that debt is based on a portfolio of machines that it's encumbered against. And so if those machines produce a lot of profitability, we pay that debt down quicker. If those machines, post-having, don't produce much money, then we don't have an obligation to service it. And so I think that is really, really important because a lot of machine financing that happened in the past, people finance it, you have fixed monthly payments, and then if energy rates go up or Bitcoin prices go down, you get kind of squeezed and you have to have a balance sheet to subsidize that if the miners can't do it. And so for us, 4 years, I mean, this whole business is about the highs of highs and the lows of lows. And ideally that volatility will kind of smooth out over long periods of time. But in 4 years, we believe that machines, there will be very profitable times, there will be less profitable times, and having a strong balance sheet to acquire when things are less profitable is great, but having debt that's structured like this that gives us that flexibility is extremely important so we don't have those liabilities in that mismatch scenario. And then the last tranche of debt, which is our largest piece of debt, over $80 million, was the membership loan that we got in our joint venture on the King Mountain site. And I'll talk through the debt, then I'll also talk through the philosophy of why we did it, because I think it gives people perspective of how we think about the business. So that debt is also a 5-year note, 4 years left because we're about a year in. And the way that debt is structured is instead of a payback on like the miners that are hashing there, because that's a 280 megawatt facility, we have a portfolio of self-mining, we have a hosting customer, the payback is based on the dividends of basically that project, right? So we have cash flows, we have profits, that money gets dividended out, and then our dividends get cash swept against the debt that we have outstanding. And so there's no minimum payments. I think you see that as a recurring theme. When you have key minimum payments to pay, you take risk because if you don't have a strong enough balance sheet and your cash flows don't support it through volatility of Bitcoin price, that's when you have exposure. And so on this note, it's based on the dividends of that joint venture. But furthermore, at the end of 5 years, if for whatever reason there's still a large amount of debt outstanding, and actually that debt has been paying it back ahead of schedule, so it's actually very healthy and doing well. But at the end of the 5 years, let's just assume that hash price goes down and customers default and it doesn't actually service the debt. There's no parent recourse. There's no recourse to the parent company. The only recourse on that note is our interest in that JV. And if the interest in that JV couldn't even pay off the loan, then the value of those interests probably aren't that high anyways, right? And so I think that's extremely important because when you look at it, it's like, oh, you have 9 figures of debt, but like you have almost half of that isn't even parent recourse. And so I think that's really, really important. So let me give you a philosophy of like why we actually did that and why I hope we can continue to have those opportunities is when we looked at the site, this was a site within the Compute North kind of bankruptcy, and they had built it for like $240 million. And because they bought machines at the peak of the market back in 2021, and then they had the infrastructure. And so we couldn't really get there on valuation, right? We were like, look, this is like the replacement value. This is that we built for very cheap. This is how much we could buy for. And we couldn't really get there. And there was a big kind of spread because like the counterpart didn't wanted to write things down as well. And so the way we got there was like, okay, you know what? Like to own 50%, which in theory would be $120 million of like cash that they spent to actually achieve that, like we only had to put down $10 million. The rest was all seller finance with no parent recourse. And so for us, it's a very cheap option at a massive facility that has really great rewards, especially if the market's like, and they have played out where they've done very, very well, right? And like that was like peak kind of like bear market 2022. People thought like Bitcoin was never going to come back. People were terrified. And it was a great way for us to have massive ownership without putting massive cash down. And so we took on this debt, and without having that parent recourse, we said the risk is isolated. And so that is important because as we think about growth, like Bitcoin mining companies and infrastructure and energy companies or data center companies are high CapEx businesses. You have to be thoughtful on how you raise money where you can drive down your cost of capital, because if your cost of capital is high, no matter how high your returns are, it might just balance each other out and it might not even make sense. And that's why like when we think about cost of capital, there's 5 levers. There's pulling equity, and equity in my opinion today is very expensive because we're trading near a HODL balance, right? It's the cost of equity is really expensive. And I'm one of the largest shareholders in the company as well, so we're very sensitive to how do we grow shareholder value over time. The second is debt. I don't want to take on corporate debt because I think corporate debt, there's liabilities we're going into the halving. I want a strong balance sheet. The third is project level financing. I love project level financing, and I think it's mutually beneficial for the company and for the investor. For the company, it limits dilution, but also limits risk. For the investor, like a lot of investors when they invest in companies, they take SG&A risks, they take execution risk, they take like, in the Compute North example, the ability, like if you want to go and really expand, they take kind of that execution strategy risk. But if I'm an investor and I just want exposure to a mining site, and I underwrite this site, it's 100 megawatts, these are the machines going in, you're really just taking hash price risk at that time, right? If you assume that the person can build and operate. And so there, investors get a lot more pure play exposure and don't take all of the extra risk. And you can model in, hey, the management fee we're going to charge is this. So there's not SG&A risk where it can balloon and things of that nature. And so I think for the investor who wants kind of project level, like pure exposure, they can get that without all of the other risk factors. So I think it becomes a mutually beneficial relationship for people who want that exposure. The fourth is we have a large Bitcoin stack, so we could sell to fund growth. And the fifth is because of the large Bitcoin stack, people love the proxy they have to the upside of Bitcoin. And so that's why we're looking at a lot of different option strategies where we can pull money off of the stack, still maintaining the upside. So that's how we think about capital. That's how we think about debt. And like, we're very, very thoughtful on the debt that we have, because in this next cycle, the whole reason we merged with HODL is how do we go and acquire more businesses and have a strong balance sheet and have a public stock and not be the ones getting acquired. And if you have bad debt, you're going to end up on the other side of that equation. And so I think, thank you for asking the question. And I think going into detail is really important, because the headline number looks scary, but when you break it down, it's actually really well thought out and well structured, in my opinion.
Yeah, I would definitely agree, Asher, and I'm glad you took some time to walk through that. I do agree with avoiding parent level debt. I like the partnered individual project approach, and we're starting to hear that a lot more in the industry. Now, I wanted to touch, I think it was your fourth lever there, the HODL. Sue, you and I have talked about your guys' HODL for years and years, and you were always mentioning Jamie was such a big advocate, don't touch the HODL. It looks like you've done your best, Asher, to kind of preserve that piece of the past. But you have enough Bitcoin, you could just sell that to clear up your debt, and you're specifically choosing not to. Now, we had Paul Prager from TeraWolf on, and a number of other CEOs that are dead set against HODL. They basically say, hey, we're unsure of the Bitcoin price in the future, same as everyone else in the world. Therefore, we don't want to take that risk of potentially interrupting our investors' money. You guys obviously are on the other end of the spectrum and believe there's some value in holding Bitcoin on the balance sheet, like we've seen with MicroStrategy and a lot of your peers. Can you talk to us about that HODL strategy? Why is it so important to keep that on your balance sheet? And why are you open to taking debt in place of selling that HODL?
Yeah, so I think it's important to understand like what our shareholders want, right? Because at the end of the day, we work on behalf of our shareholders. And I believe shareholders buy mining companies to get exposure and lever exposure to Bitcoin. Like that, people are not buying a mining company to just get an EBITDA return. They're getting exposure to Bitcoin. And so historically, when we merged with HUD had a very strong shareholder base that loved the HODL balance. And I think it's honoring those those people who bought those stocks. So today we actually sell live production. That's why you haven't seen the HODL stack going up. And so we actually have a split approach. But we want to maintain that exposure because a lot of our shareholders, we believe, want that exposure. On the other hand, when we look at growth opportunities, so when we go and buy machines or when we go and buy facilities, you're really still taking exposure to Bitcoin, right? Because the machines and the infrastructure is going to be more valuable, and it's actually levered exposure because they actually produce a yield of Bitcoin as well. And so we're swapping exposure. We're not selling Bitcoin and losing that exposure. We're actually swapping exposure. And so right now, rather than kind of just selling and holding cash or whatnot, like we're maintaining that exposure. So even though in the last, call it 7 weeks since I took over, I haven't announced a big exahash number and a purchase of machines, I think you can do that within 24, 48 hours. Machines are available, right? But I mean, our Bitcoin stack has gone up a lot in value in that period of time. And the machines haven't gone up as much from a percentage perspective on the cost of that machine. I would argue that machines have actually gone down a couple percentage points. And so like, that is really important. So when we think about kind of the HODL balance, I've also shared that we have a new treasury management strategy. We're willing to take options against the Bitcoin stack to pull cash out. And look, if there are times where if our stock is trading near our Bitcoin balance, we will sell Bitcoin to fund growth, right? Because we believe the cost of equity is that much more expensive, or we can always bring on more Bitcoin down the road if we need to. But it's really where can we pull the cheapest cost of capital to fund the best growth opportunities? And over a long period of time, that's going to generate the best return and the best yield. Because I'll give you an example. If we can go build a site for $275,000 a megawatt, and we can buy ASICs for kind of mid to low teens per terahash. If we go and we swap some of the exposure from the Bitcoin into those assets, if Bitcoin goes to 150,000, all those assets are going to be more valuable as well, right? So you still maintain that similar proxy exposure, but also those assets produce yield on top of the actual value of themselves. And so what we're looking at is really balancing and creating the best return on the assets that we have, rather than just kind of being a one-trick pony and saying, this is what we, this is the only thing that we're going to do, because different markets, I think, require different strategies to maximize the value and the opportunities within those markets. When, like, currently, I think a lot of kind of how the markets have worked historically is when the markets are running, everyone's raising money, whether it be equity or debt, they're buying machines, they're buying infrastructure, everything is more expensive because there's so many people buying, and when the markets turn, no one has money, no one's buying, and everything's really cheap and no one can purchase. And so I think it's really being a contrarian and being on the right side of being a contrarian, because you're either a contrarian and you're right and you're a genius, or you're wrong and people think you're an idiot. And so I think it's being thoughtful. And so when we think out about like machine purchases, it's not this kind of magic ball that we're like, oh, machine prices will go up or down, this is what we feel. No, it's a lot more thoughtful. It's, okay, where's the origination of where machines come from? Machines come from the foundry. That's how it all starts, right? You have the chip, whether it be for TSMC, from Samsung, from SMIC, the chip has to get manufactured first. So what is the cost of that wafer? Okay, what is the cost of the wafer? So that's the cost that the manufacturers pay. Bitmain, MicroBT, Canon, Aeronine, whatever, whoever are the manufacturers. Then it's, what is the supply of availability of chips? So when you look at 2021, chips were in short supply. Even car manufacturers couldn't get enough chips, and that's why you couldn't buy cars in 2021, and used cars went up so much in pricing, right? Chips are no longer a bottleneck. The production lines, the supply chain, the COVID era supply chain disrupts have gone away. Okay, so if you can buy the chips now, and there's a certain cost per wafer, then there's a baseline cost basis. And so when we look at kind of the macro markets as well, you have the halving coming up. No matter where Bitcoin goes, your revenue is getting cut in half, right? So right now, it's better because your revenue is up whatever percentage for the last 2 months, and I think price is bailing a lot of folks out that otherwise would have had to shut down. But regardless, that revenue is coming down one way or another. Then looking towards the end of the year, based on, so TSMC has come out with a 3 nanometer chip, Samsung, et cetera. They've announced a 2 nanometer chip for years now. We believe kind of the first production runs will be towards the end of the year. So I think this year you'll see kind of a second generation of 3 nanometer chips that are a bit more efficient than the S21s. And I think there may have been an announcement today, there will be soon. And then people are going to start working on the 2 nanometer chip, right? So we think kind of sometime this year, you'll see the second generation of the 3 nanometer, then you'll see the 2 nanometer roll out sometime next year, right? And so you'll see those efficiency increases, and those will continue to plateau because TSMC hasn't even announced the 1 nanometer chip. And so I think we now have a couple of years within kind of, we're so dense down when it comes to compute. And the analogy I always give people is like when the iPhone first came out, every year you had to buy a new one because it was that much better. And now every time it comes out, you're like, I don't really know what the difference is. Maybe the camera's a little bit better. And so I think similarly, it's because kind of the efficiency increases more as well as plateauing, and the underlying chips are very similar that you use in a phone in the machines. And so, all right, halving happens. People know new machines are coming out that are more efficient. What that means is people are going to say, hey, are these machines still worth what they're worth, right? Because right now you're at kind of peak, hash prices up, machines, we got to buy them, we got to grow, and you're at peak demand. And so in my mind, if we're thinking of spending 8 figures or 9 figures, $100+ million in machine purchases, is really waiting 1 or 2 months going to hurt us, or is it going to benefit us and we're going to buy that much more machines and have that much better of a return? And so it's not about just waiting for the new generation machine, but it's how those dynamics in price, the pricing across everything else. And when we look at machines, we look at what do we believe kind of network hash, like I don't think of Bitcoin price and difficulty, I just think of hash price. Right? Hash price is the metric I look at, and it's going to be the equilibrium of worldwide energy prices on average and worldwide efficiency. And that's kind of that equilibrium that it'll always kind of drive down to. And when you think about hash price, what we look at is, okay, this specific machine, how much can it generate in profitability based on the energy that we believe we'll have in hash price in terms of terahash profit per month? And then based on the efficiency of machine, how much are you contributing to buy that machine, but also the infrastructure cost? Because if I have an S21 versus a S9, for example, right, like one of the oldest machines, like that rack space, for us, we announced that we're going to build at $275,000 a rack, or $275,000 a megawatt. like that rack space on a more efficient machine, you're utilizing more of that rack space, and so your cost per terahash goes down, right? So when we look at these numbers and we look at the return profiles, we're looking at them relative to how much you think we'll make, and what is the cost of that miner, and what is the cost of that infrastructure. The same infrastructure will cost more on a less efficient machine because you're using that opportunity cost of that megawatt. And so that is how we think about the return profiles. And it's not always, let's buy the newest generation machine. Let's buy the machine that we think has the best longevity and pays back in the soonest amount of time, and then has a tail that we can reap the rewards of.
Just a quick add-on to that. I mean, I'm assuming that you as a big mining company, you're getting access to test all the latest models from the manufacturers. So you'll have tested the Micro BT, you'll have tested the S21 T21. I mean, we had Ben Gagnon on a couple of weeks ago, and they've tested the T21 and got exceptional results. 30% higher than what it said on the box. And so, are you doing this sort of? Are you doing this testing now in your environments to see which ones look good? I mean, I've just seen today another announcement from Bitmain. They brought out the S21 Pro.
Well, I didn't know if it got announced or not. That's why I was like, I think there's an announcement. I was waiting.
It's now load the bar. It's 15 joules a terahash, and it's being priced at around $18 a terahash. So that's another model coming in.
And people were like, "Are you sure there's a new machine, etc." I was like, "I think it's coming out, and I think there will be more." And so, like, look.
Oh, there's a definite race in this. I mean, we had BitDeer on yesterday, and their first generation model they brought out is 18.1 joules per terahash. That's the first generation. They've got 50 staff working in R&D to try and to improve that, and I'm sure with their background there'll probably be more miners. And you've articulated with Auradine and other new entrants, Block, are also building mining machines. So end of 2024 is going to be really, really a competitive landscape where you've got the choice of a whole selection of them, and it might be that you actually utilize this time now to get ready for what's coming. So like that.
And I think that, like, we're active, right? Like, everyone knows we have a large balance sheet. So that means all the manufacturers are coming to us because they want us to buy stuff. All the M&A opportunities are coming to our table because they're like, hey, you have cash, would you like to buy? And we're looking at a lot of greenfield projects. So, like, we're very, very active. We're also I'm a penny pincher. I want to be able to invest in, like, Sue will tell you, when we travel, I'm like, hey, if anyone spends more than $300 on hotels, we have this massive Slack group with our whole company. You've got to post in there and explain why you want to spend more, right? Like, I'm really thoughtful of how do we control those costs, because being a low-cost operator in the space is how you win. And, like, I deeply, deeply believe that to my core. And so with that said, like, we're looking at all of these opportunities, and when the opportunities come, like, I want to have the best investment opportunity, but I also won't be scared to make decisions. Like Salt Creek, within my first couple of days of being CEO, I made that decision to say, we're going to build this. We have to go and execute. We will sell Bitcoin if we have to. Luckily, our cash flows were able to basically fund the growth of that project. We started that project in February. That will be fully online next month, fully online. From greenfield to build out, that's 63 megawatts, fully hashing. And I think, like, at under $275,000 a megawatt, right? And, like, you guys are very, very well in tune with the space. Like, that's very fast, that's very cheap. And, like, I'll show the world that will be very good efficiency as well, right? So we're not sacrificing quality. And so with that, like, we're looking at opportunities, and as the right ones come up, we will be decisive, we will act quickly, and we will execute. And I think that is the confidence that I want people to see. Is like, today, we manage 27 exahash across all of our business units. So the question is not if we can do it, we're already doing it. And we're showing that if we want to grow, we can grow really quickly as well. But it's being thoughtful and it's being patient. And if you think about, like, look, a lot of shareholders who buy kind of mining stocks and things of that nature, like, buying when a company is cheap, you have a lot more torque and upside when it goes up versus buying high. And so it's similarly to buying machines. If I'm able to buy for X percentage cheaper, it's only going to compound my return on that investment exponentially higher, right? There's an asymmetric return to the pricing of it and the risk profile that you're taking on.
Yeah, I was just going to say, just highlighting culturally how Asher's taking a different lens in terms of how we return capital, and especially the cost of capital, and, like, really penny pinching every single piece of this business, cleaning up that SG&A. I'm actually probably going to start a series called How Cheap Is This Hotel? So that the investor audience can guess how much we paid, because we're not allowed to spend more than $300 a night on a hotel. And I've found some real doozies that we've had to stay in. And then whoever guesses the right price, I'm actually going to send them a Hut sweatshirt, send them some swag. Because that I think really speaks to how Asher just looks at this business as a whole. It's also flights and economy.
And then I sent an email, right? Like when I took over this role, there were senior executives that were flying business or first class. They were staying in 5-star hotels, and I basically sent an email. I'm like, hey guys, like economy moving forward, and if it's above $300, I have a group chat with 200 people in the company. Post it in there and explain why you think you should be able to spend more than 300. I'll respond. But if you are not comfortable saying it in front of the whole company, then you shouldn't ask. And I'll do the same thing myself and lead by example. And I think this goes also to like the Sam Waltman, like the kind of Walmart story of like, he flew economy during the whole course of building that business, and they built one of the most successful empires and family wealth generations in the world, right? And so I think like leading by example matters, but also like not forgetting what business you are. Like we are a business that's infrastructure focused, that is focused on low cost. And like today, we have a lot of hair to clean up, because when we merged with Hut, we had the operations, we had the scale, they had the balance sheet. There were a lot of sites that needed to get fixed, and again, the merger took longer. And so a lot of what we're going through is like making those changes and making those decisions and building a business that, and I hope people see, like just turning off Drumheller increased our exahash, our Bitcoin mined per exahash by 11%, and 44 Bitcoin mined per operational exahash in February. When I looked at all the other production numbers, like put us in the highest quartile of production results. And that was just one action that we made, right? And there's a lot more to come.
Yeah, Sue, me and you had a chat about, I think, just over 2 years ago when you informed me that the company were going into the HPC space and you bought your 5 centers. We've had a number of CEOs on the podcast in recent weeks articulating their move into HPC. We've seen some big clients announced. We've seen some, potentially big revenue streams with a few of them as well. What's your stance now on HPC, going forward with the fact that you're obviously focusing on the 3 elements of the mining sector that you're doing?
Yeah, so I think our approach to HPC is a little bit different. I think what I've seen in the market is you have some of our peers that are doubling down on mining, and they're growing, they're doubling down. You have others that have kind of taken the gas off of mining and said, we're going to go into AI, data centers, HPC. Our approach is a little bit different. So when we think about kind of the long-term business and what the business is going to evolve and continue to grow into, the underlying platform is energy infrastructure. We're big believers that over the course of the next 10 years, energy infrastructure will continue to be more and more scarce because demand will outstrip generation and new generation coming online. And that's Bitcoin mining, that's AI data centers, that's green hydrogen, battery technology, carbon capture, you name it. These are high density loads that are coming on, where historically the only high density loads were like big manufacturing facilities, right? And so you're having this whole new wave of demand coming on for energy. And as you know, with the energy markets, like it doesn't just get built overnight, right? Big power plants and the regulations around it and the tax subsidies, and there's a lot of nuances there. And so when we think about kind of the overall energy landscape, why Bitcoin mining is amazing, one of the main reasons that I co-founded US Bitcoin Corp was it is a flexible load that can be really, really valuable in areas where you have volatility in production and you have volatility in energy markets. And so Texas is a great market as an example. You have 4 cities that really consume the majority of the power. That's Dallas, Houston, Austin, and San Antonio. You have a lot of the production of power in West Texas and kind of the Panhandle area. And so I believe it's like 5 gigawatts of production, right? And to put in perspective, 5 gigawatts is 5,000 megawatts. Each megawatt is roughly like 600 homes of energy, right? So like lots of energy. You really only have 3 transmission lines that take you from kind of that west, northwest kind of power hub down to the cities, and that's 3 gigawatts. So you have 2 gigawatts of power that's just there. And you have these interesting energy markets. Sometimes energy markets go negative. So you actually make money when you consume energy. And why that happens is kind of how the IRAs and tax subsidies are structured for when you have wind production credits. So you have to produce the power to get the tax credit. And so if you get 3 cents on the tax credit, you don't care to lose a penny to make 2 cents, right? And so that's why sometimes you have those markets. So when you put a Bitcoin mining load there, first of all, these places are kind of very rural, middle of nowhere, not big population. So you can't go build a massive manufacturing facility. And data centers, a lot of them don't actually have the fiber connectivity. And so you can't build a data center. And so Bitcoin mining facilities you can put there, you can build out, and you can basically consume the power and trade around those energy rates. So I kind of said this in my earnings, but if you took West Load Zone and you ran 24/7, 365 last year, and we kind of ran this simulation, your all-in cost of power is like high fives, all right? Like 5.8 cents or something like that, high 5 cents. Now, if you ran curtailment on it and you shaved off the peaks and you curtailed just a little under 9% of the year, now your cost of power is like 2.6 cents. So that shows you how big the peaks and the troughs are. And so when we look at Bitcoin mining, the value we see is stranded power, consuming low-cost power. It's good for Bitcoin mining because you want low-cost power. It's good for the energy grids because they need consumers of last resort. And then the next layer is data centers. Data centers need more high uptime, more redundancy, more internet connectivity. And so historically, we've seen some Bitcoin mines around cities that now there's appetite of like, hey, our latency for AI is less than a traditional data center. And so we can go a little farther outside of the city. And now you see some overlap in Bitcoin mining versus AI that are closer to cities. And so you see basically that consumption and like these super pods. So we're running 1,000 GPUs H100s, right? And that's like a super pod. It's a supercomputer, and that's about a megawatt, 1.3 to 1.5 megawatts, right? That's capacity. Now you're starting to see super pods in the thousands of machines, and that'll only get bigger and bigger because people want that concentration of compute and to build these models in days and not months and years. And so you'll see that grow. And so that when that grows, energy capacity continues to grow. And so when we look at the bigger market, and this is a big way of answering your question, which is energy is the underlying uniform value. Our job is how do we maximize the value of that energy? So for stranded power, Bitcoin mining, and over time, the definition of stranded power will change as more use cases evolve. And then data centers capture a different type of power demand and power capacity. And so when we think about it is, we want to be a very valuable company over time and build a very valuable company. We think by just being a Bitcoin mining company, you're capped. There are only so many Bitcoin that get produced every single year, and that number drops in half. And so for us to be the scale and the size of the company we want to be, we have to be more than just a Bitcoin mining company in terms of the energy that we consume and the infrastructure we own. However, we still want to be one of the largest Bitcoin mining companies, but we want to be a bigger company than just that. And by having these other assets, similar to our managed services business, it actually drives down our costs to be a Bitcoin mining company because we can share our SG&A costs. We can have an energy team that sources for both. And so I think that overlap, those overlaps make us become a better Bitcoin miner and let us be able to be a Bitcoin miner at lower cost and a bit larger scale.
No, thank you for that. Yeah.
Yeah, there's so much to this story, Asher, and we're hearing more and more companies, going into other revenue verticals, but also calling themselves energy infrastructure companies rather than just Bitcoin mining, and really understanding that energy is going to be the next most valuable resource as all these new industries, like you mentioned, come online.
I was going to say that's one thing that is important, right? HODL got into kind of this diversification strategy like earlier than I think most people in the sector. When we built this managed services, people were like, what are you doing? Why are you doing that? Why are you not just in like now 68% of our revenues were from self-mining. The rest were diversified last year, right? And so I think you're seeing more people adopt that, even though originally the mindset was like, why would you do that? And I think that will only become more and more prevalent. And as we continue to grow, we hope to continue to lead kind of thought processes of diversification and scale.
Yeah, for sure. Now, I know we've covered a lot here. Sue, before we wrap up, I just wanted to get your take because you've seen this transition from the inside. As Asher mentioned, it took almost a year. You've been on the show for years now, and you understand the appetite of the original Hut 8 mining investors and now obviously the US Bitcoin team as well. How are you feeling about things, the new leadership, the new direction, the new strategy?
Yeah, like I said, I'm incredibly jazzed about the lens that Asher brings to this company, even from, again, a grassroots, what price are you paying to stay in hotels? Because again, at the end of the day, it is how do we return the absolute most value to shareholders? And so I'm just looking forward to the next couple quarters, particularly educating the street on why the strategy that we're taking matters, acquire as many megawatts as possible for as cheap as possible, still stay incredibly bullish on Bitcoin mining, continue to build out meaningful JVs in the renewable energy space. We've already got 50% of a substation in one site. We own another station a substation at Salt Creek. And again, just really educating the market on just how meaningful this story is and the total addressable market that we're capturing beyond Bitcoin. This is an energy play. is something I'm really jazzed about. I'm really excited about. And yeah, thanks so much for having us on.
And one just record clearing point, us saving $100 or $200 off a hotel is not going to move our bottom line, but it creates a culture of being low cost and being thoughtful how we spend money. And I think that's where these small little things make a big impact on how people operate on a daily basis. And it's a cultural shift of how we build these businesses and how we think about the capital that we spend and how we're being good fiduciaries of capital.
I also, you know what, there's actually one more thing I want to talk about, just speaking about how we think about this business, because we are owners in this business. We did actually release yesterday some changes to Mike, the co-founder of US Bitcoin Corp, and Asher, obviously the co-founder of US Bitcoin Corp, now CEO of HODL. We released some changes to their incentive plan, and maybe Asher, you can quickly talk about what's changed and again, how it's effectively getting us more aligned with shareholders.
Sure. So usually kind of executive comp, you have like from an equity perspective, it's usually kind of split with RSUs and PSUs. And what an RSU is a restricted stock unit. So it vests over time, right? Whether it be kind of traditionally, it's a 3 years. So, hey, you stay here, you have a certain amount of stock and invest over 3 years. And then the second one is performance-based units. So you only get this if you perform. And so when we spoke to the board, we said, look, we're big shareholders in this company. We believe in what we can build, and we'd rather take 100% performance stock. We don't need to get paid for being here. We need to get paid for executing and delivering results. And so the way that we structured it, we also didn't use metrics like just exahash numbers. And the reason why is because I can solve an exahash number by just going and raising money, and I can raise money today if I wanted to go solve that number. Like, I think how many exahash we bring on, what our cost basis is, all that inevitably drives down to earning and kind of our share price and also the market getting confidence in our company as well. Right. So basically the metric we use for the first year as we kind of show the market more of a path of like how the businesses mature in the next year is the return on stock price, not the return on market cap, because market cap increases as you raise more money as well. It's a return on each individual's share and the return on that share. And so the leverage is we hit kind of the max return once we double the stock. And it's a 3-year testing period. Year one, however, we don't test. And the thought process is like yesterday, our stock did well, we had good earnings, but we want to build real intrinsic value in this business and not just get rewarded for kind of like short-term driving down, especially with the halving coming up. We're saying, hey, we know the halving's coming up and we still want to double this business. And so basically the first year, we don't track anything. Ideally, all the value we build in the first year will continue to be retained and compound going into the second year. So second and third year, we start tracking over a 20 trading day VWAP. And then once we hit that metric, then those shares only vest to us at the end of the 3-year period. So we don't even get to.
So basically,
yeah. So you go for it.
So basically, you have to hit the metric and then hold the metric for 2 years, and then you get your equity.
So we hit the metric, and then we retain the value of those shares, and then we get at the end of the series. And also, our board has also all opted into taking all shares in the company and no cash comp as well. So they're all fully aligned and incentivized as well. And I think like that alignment is extremely, extremely important. And we hope to continue to show those actions in how we're aligned with shareholders going forward, being me and Mike being two of the largest ones in the company as well.
For sure. I love the fact that the board's taking all their compensation in stock. And I love the ambition, Asher, of both you and Mike, because part of that lockup period, that's going to take you into what a lot of people think could be kind of the bear cycle for Bitcoin. But because you've got those alternative revenue streams, you're focused on that new culture. Obviously, you guys feel confident about retaining that share price value despite the ups or downs of Bitcoin, which I think is commendable. So I know we've covered so much here today, you guys, everything from earnings to HODL to growth to the partner strategy, executive comp. I'll throw it back to the team for any closing thoughts or anything we maybe missed. Anthony, I'll start with you. Anything left on your mind there, buddy?
The only thing left on my mind is that travel to Nashville for you, Bryce. I'm thinking of giving you a pair of trainers rather than a flight now. I think we can do better than the flight. Give you a pair of trainers, set up a few days before.
I'm going to walk, buddy. I'm going to walk and bring a tent. We're going to do Asher one better. I'm not spending any hotel money.
It'll probably be nicer than wherever I'm staying.
Yeah. I'll bring a big tent so you can camp with me. Okay, Asher, any final thoughts from you?
No, I think just stay tuned along our journey, and we'll just keep on keeping our heads down and executing.
Great. Thanks so much, guys. And I just wanted to reiterate, Asher, you said really the big changes are going to be noticeable in Q2. So if we're already seeing some of these big earnings releases now, we're obviously excited to see what comes. So great job, you guys. Congrats on a phenomenal earning. Obviously closed today, you guys. Good Friday. So happy Easter to everyone. Asher, Sue, and Anthony, actually appreciate you guys making time today. If you're still watching, hit the like button, click subscribe. We'd love to have you as part of the community, and leave a comment in the section below. Let us know what you thought of the discussion and your outlook on HODL Corp. You guys, thanks so much. Have a great long weekend.
Bye, guys.
Thank you very much.